Hello investors, thank you so much for joining me. My name is Michael from Deep Value Returns on Seeking Alpha. Today I want to talk about DraftKings. So DraftKings reported their results Q4 21 on Friday, and they reported it early in the morning, and I haven't had a chance to cover it, so this is kind of the first time I'm looking at covering it. The guidance is pointing towards mid 50s, so it's clearly not growing as fast as it did back in 2021. So the growth rate in 2021 was approximately 211%, sorry, 212% year over year. So in that context, it's not growing as fast. But the thing that investors are really kind of knuckling down and focusing on right now is the path to profitability. So in conclusion here, I kind of say that investors should really follow DraftKings management and not buy any more stock in the name. I'm not talking about the stock-based compensation, that the options that they're cashing in, but just actual clean purchases. So I think the investor would do well to avoid this name. So let's just dig in. The stock, as you can see, is down substantially in the past 6 months. It's been one of those stocks, like a lot of other names, just dramatically sold off in the past 6 months. Now, here's the thing that we should focus on. Okay, so the growth rates for 2022 are pointing to approximately 54% year over year. Okay, now you have to keep some things in mind here. The first thing to keep in mind is that H1 21 was particularly strong. You can see here in the graph that they were reporting very strong growth rates. So as we come to lap that period, it's going to be a tough hurdle. That's the first thing. The second thing is that a lot of its growth has been driven through acquisitions. So does it have a lot more wiggle room to make substantial needle moving acquisitions? So I don't really know the answer to that question, but I just wanted to put it out there. So they talk a lot of us, as you would expect, during the earnings call about their profitability. And they're saying that if they hadn't gone and grown so aggressively during Q4 21, they would have already reached adjusted EBITDA profitability, and that as the market is expanding, the total addressable market is expanding, and that they're making investments on their platform, they are going to grow a substantial amount in 2022. Now, here's a few things I want to highlight. Okay, so monthly unique payers for H1 21, so the first half of 21, was up 62% year over year. The second half of 21 was up 32% year over year. So I've always said follow the customer. The customer knows better. If you're seeing a very large drop in the number of customers coming to a platform, the business is not growing as fast as it previously was. It's a very clear step down. And that's obviously down to some competition, because it's really, the customer base is not very loyal, right? Ultimately, they're making a bet, right? So there's not a lot of, not going to remain very loyal, because you're going to go where you get the most bang for buck, right? So why would you stay loyal to a platform? You can just go and get a discount somewhere else. You just go somewhere else, just a few clicks. There's no reason for you to stay on a platform. A lot of them are just very similar. How they kind of it's ultimately down to the bonus that you get in. Now, the other thing that I wanted to highlight is you can see here in the graph. So this is the adjusted EBITDA numbers, and you can see that year compared to 2020, 2021 was negative 676 million. Okay, so 2020 they were negative 400, then 2021 negative 670 million. So as it looks right now is that the more it grows, the more unprofitable it becomes. But you have to keep in mind that for 2020 the EBITDA margin was negative 62%. And for 2021, the EBITDA margin was negative 52%. So there is a step towards improved EBITDA profitability. And if you look at the guidance for 2022, it's pointed to negative 44% EBITDA margins. So there is a clear progression from 62 to 44 negative EBITDA margins as time progresses. And what you have to think about is what they're adding back to the stock-based compensation. So I highlight here. So for 2021, top line grew by approximately 211% year over year, and at the same time, stock-based compensation grew by 210%. So as top line grows, EBITDA, stock-based compensation also grows. Okay, that's kind of like as you would expect. Now, here's the question for you: as DraftKings grows in 2022 by approximately 54% year over year, does that mean stock-based compensation is also going to grow by 54% year over year? I don't think the answer to that is yes. I think that you're probably more likely to see the stock-based compensation continue to grow at close to 100% year over year than you are to grow at a more subdued rate, because ultimately you need to retain that executive force, right? You're not going to be able to retain them if you pay them less. Like proportionally, you're gonna want them to remain really motivated to kind of grow that top line. The next thing you have to think about is as the share price collapses, you're gonna have to actually increase the amount of stock-based compensation, because that stock-based comp that you're offering is worth less. So you need to increase that. Then you also have to think about the fact that management knows that they can go elsewhere, and that your stock is pretty much worthless, and you're thinking to yourself, okay, shall I stay here or not? And then they're gonna have to be offered a cash bonus. So that goes from it being a non-cash expense added back to a cash expense that gets added back. So that's another thing to think about. The other thing that I wanted to make is that if you look here, you can see that the price to sales multiple right now is at approximately 3.5%. But then you gotta think about there's 429 million shares outstanding, so that the market cap is approximately 7.4 billion, which is a little bit higher the multiple than it shows here. But because this number doesn't account for the extra warrants that are being cashed in. It will adjust in a few days. But for our purposes, we can see that about 6 months ago, people were paying 18 times forward sales for this business. And right now the multiple's compressed and you're paying approximately just over 3 times forward sales. So that clearly, that has to be a bargain. But you also have to keep in mind that 6 months ago, for H1 21, they were growing like really fast. And there was still the expectation and the hope that this business will continue to grow really fast. And they're not. Their guidance points to, mid-50s. So as the growth rate compresses, so will the multiple compress. And then people are going to start thinking about, okay, is the business going to be profitable anytime soon? I'm not talking about that kind of heavily adjusted, massaged EBITDA number, just a clean profitability. So it's a difficult case here. I think that if you think about it, there's so many really great bargains out there in the market right now that it's difficult for anyone to kind of say, okay, I will just go and buy DraftKings, because it's an interesting investment, right? So you're looking at something that, if we look out and we consider management's guidance, by Q4 23, so next year, by the end of next year, they will be reporting adjusted EBITDA positive numbers. But as I already discussed amply, that EBITDA number is something that's heavily massaged, and you're not going to see a clean profitability here for some time. So it's just some things to think about. And I already discussed the likelihood that the portion of that stock-based compensation gets translated into actual cash-based compensation, which will dampen the free cash flow here substantially. So these are just some of the angles to think about, and why I'm not going to be kind of buying any stock here. But if you want to find out what kind of names I'm buying right now, don't forget to check out my marketplace. It's called Deep Value Returns. Come on board, drop me a line. I help you become a better investor. You can check out what other people have said in the reviews as well. Okay? Good luck throughout the earnings season, and I hope to see you soon. Bye-bye.